let's talk more about the banks. Financials were one of the worst performing sectors in today's sell-off, but our next guest says today's move pales in comparison to what may come as banks gear up for their annual stress test results. Let's bring in Christopher Whalen of Whalen Global Advisors. Chris, great to speak with you. Good to see you.
Yeah, nice to see you, Melissa. I hope everyone is well.
You think that dividends are at risk here across the board or just some individual stocks?
A couple of months ago, I would have said no. I would have said ending share repurchases, which is worth $130 billion for the top 25, was enough. But, you know, that provisions number the Street put out in the first quarter was big. It was up almost 400%. So what we got to look for in second quarter earnings is what are they doing with provisions? If they come in lower than the first quarter, that tells you they're getting confident and that they have a basic idea what they're dealing with for the year. But if they come in the same level or higher, it tells you that we still don't have visibility. And remember, we're talking about credit loss. There's no vaccine for credit loss. You know, it's fine to talk about the Fed. I agree with your previous guest. I've been in and out of these. I kicked all of my equities out, common equities out on Monday. I just own preferred because I want to go higher in the capital structure for a while. I don't want my feet to get wet, if you know what I mean.
Right.
So what I'm saying is that you really got to understand that this is a 1930s type situation. This isn't 2009. This isn't about liquidity. It's about credit loss. And the broad swath of America in terms of corporate credits, commercial real estate, is going to take a big bite out of the banks. I think losses this year could be twice 2009.
Right. I know you're concerned about commercial industrial loans as well, on top of CNBC.
Consumer's great right now. Bull market in resi, by the way, this year. We're going to do $2.5 trillion in residential mortgages this year.
But Chris, I'm wondering, how do you think we should think about provisions? I mean, as I understand it right now, provisions are about half of what they were at their peak 10 years ago for the banks across the board. You said this is a 1930s scenario, so should they be even higher? Because that would put a serious dent in the banks if they had to just put that capital aside.
Well, it's good to consume earnings first and foremost, Melissa. That's how the industry got through 2009. They directed that earnings power at the problem, and they dealt with it. Same thing here. You could easily see earnings for this year get consumed by credit costs, and they may get it back later. Remember, provisioning in 2009 was 2.5 times what they actually charged off. So it looks ugly up front, but then they recover a lot of value later on. This is about time. And I know everybody, wants to see the market come back. I do. But I also like buying stocks below book value. And that's what I've been doing since I was on last, is that, the preferreds, the commons have been very interesting in the bank space. Really, I think a very long-term opportunity to get in. And you may have another opportunity. I think there will be disappointment in second quarter earnings. But as the banks can give us more guidance, and as we get more data, especially about commercial, which is very lumpy, it's not like looking at consumer credit. It's a very big, very lumpy asset class.
Right.
Then I think we'll get visibility and these stocks could take off again. You've seen that.
Yep. Chris, great to speak with you. Thank you.
All right, be well.
Chris Whalen of Whalen Global Advisors. Karen, what do you think? You're an investor in banks.
I am an investor in banks. Well, so JP Morgan is my biggest position. I don't believe that they will change their dividend. I think we'll probably hear early next week what their strategy is. We'll get some guidance tomorrow from the stress test, but I don't believe for JP Morgan that will be an issue. Now, we've talked a lot about Wells Fargo. Maybe that one is an issue. I'm not as comfortable with their capital level. Also, I think that the yield is ridiculous. That's a stock price thing, but I feel like if I were to think of one to be a candidate to cut their dividend, it would probably be Wells Fargo.
Tim?
So, Chris was very bearish on commercial mortgage backs and the potential exposure banks have there. Delinquencies in June are down to 10.5%, which is highest ever. if I'm tactically playing banks and based upon what they did in the first quarter off those numbers when they gave those heavy loss provisions, I don't think you buy banks before you get there. I think you have to hear what those provision numbers are. But we had a powerful rally that really was that ferocious bank rally and rotation rally. I don't see why you don't get that. In fact, we've had that for the last 3 or 4 quarters on banks, even before COVID-19. So wait for those earnings, wait for those provisions. Why drive blind? But I actually think you're going to hear more conservative, but ultimately better tone from the banks.